Brandis, the U.S. Federal Reserve has revised its forecast for inflation, predicting that core inflation, which does not include the cost of food or gas, could rise to 3.4% by year's end. Fed Chair Jerome Powell says while the economy is growing strongly, it is still down 7 million jobs as a result of the pandemic. He also expresses concern that inflation could become an issue going forward. Here's a little of what he had to say.
The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect.
Joining us now to unpack what the Fed chair had to say is Martin Eichenbaum. He's professor of economics at Northwestern University, where he is also co-director of the Center for International Macroeconomics. Professor, thanks so much for joining us. First of all, as we mentioned, the Fed had a two-day meeting earlier this week. What was it that economists such as yourself were expecting might come out of that meeting?
Well, thanks. It's a pleasure to be on the show. We are all looking for how the Fed is parsing the signals of a rapidly evolving environment. How are they weighing the risks of on slow recovery versus too strong a recovery? What do I mean by too strong? A recovery that triggers an outburst of inflation. And they delivered on that promise and giving us insights into their ongoing thoughts about that process.
And what do you think those thoughts are? Where do you think the Fed and the Fed chairman think the economy is right now?
I think they think the recovery is stronger than they thought, say, in March. So if you just look at their forecast, so they are somewhat surprised by the growth of the economy. And at the same time, they are obviously surprised at the strength of inflation. And by the way, when I say surprised, that's not pejorative in any way. The data change, they react to it. And so I think those are the two things. Growth is good, that's the good news. And inflation is higher than they thought a couple months ago.
What is driving that inflation? Is there a direct relationship between growth and inflation, say?
Well, I think if you look at the short run, there's tremendous growth in demand for which we're all very happy as people are starting to, emerge from their shells. We've seen all sorts of shortages, some of which are due to peculiar circumstances, chips in cars, all sorts of things like that, which will cure themselves. But there's no question that as we hit the limits of our ability to produce the output and the goods that people want, firms are going to do what firms do, which is raise prices as they try and allocate relatively scarce goods amongst, people who want them.
We just heard the report from Amanda from Lyle, and she talked about how it is such a strong seller's market. The prices of homes are shooting up. She talked about how some sellers get as many as 10 offers. Is that part of the inflation equation, what's happening in the housing market?
I'm not so sure about that. I do think what's true is that interest rates are very low still. So mortgage rates are pretty low. People have built up an awful lot of wealth. Not everyone. I understand there's winners and losers. But if you actually look at savings of consumers, the stock market wealth, there's a lot of people who, thank God, right, their wealth is really up. They would like to move up to nicer homes. I think the COVID has caused a lot of people to reassess where they want to live, how they want to live. And you take all those forces, basic economics, people reevaluating life, they want homes and they're bidding on them.
Getting back to the Fed, how much of this approach is improvisation on the part of the Fed? Are they kind of making things up as they go along?
Sure, but let me be clear what I mean by that. It is a great virtue of Jerome Powell that he's not dogmatic, right? People talk about FDR and, as if in the end he was the same FDR as he was in the beginning. Now, I'm not saying Jerome Powell is FDR, but it is a virtue that when decision makers are responsive to policy and a little bit humble in what they know or don't know. So the Fed has a basic paradigm through which they view the world, but there's a lot within that paradigm that they go, sure, people are richer, they're going to spend more. how much more? If output grows quickly, inflation's going to pick up, but how much? So I think, yeah, in the sense that they're looking at data and responding to it, you could characterize that as making it up as you go along, but that could be a good or a bad. My own view is that's a good.
We have lived in a low interest rate, low inflation economy for so long that it's possible that some people have forgotten what the real danger of inflation is. Give us a Inflation 101, why it's a bad thing, why it can be a bad thing.
Well, let me give you an example. First of all, I believe, and I think most economists believe, inflation is a viciously regressive tax. What do I mean by that? Imagine that you're a worker on a fixed salary, as many workers are, and inflation goes up. That's the same as if I cut your wage, right? If everything costs 2% more, it's as if I cut your wage by 2%. If inflation goes up by 10%, it's if you got a 10% pay cut. And inflation is the gift that keeps on giving. So when it's 2, 3, 4, 5% a year, that over a couple of years, you've taken a huge cut to your salary. That just means you have less resources to buy food for your family, pay the rent, pay for a mortgage. Another example is mortgages. I'm probably about your age. And when I got my first house at Pittsburgh, when I was teaching at Carnegie Mellon, mortgage rates were 18%.
Oh yeah,
So,
that was our first mortgage too. Absolutely, it was terrifying.
It's absolutely terrifying. And if you're a young person starting off, that is an incredible burden to bear. So, will mortgage rates go up if inflation goes up? Of course. If I'm going to lend you money and inflation's going up, before I agree to lend you that money, I want compensation. So for all the young people out there, if you're going to buy a house in the future, you want to hope that inflation is low so that mortgage rates are low.
Martin Eichenbaum, some real-world consequences of the dangers that the Fed is addressing. Thank you so much for your insights. We appreciate it. Thank you.
My pleasure. My pleasure.